Welcome to the Stockscores Market Minutes for July 30th, 2012. This week's topic, somebody always knows. We'll get into that in just a moment. A reminder, you can subscribe to my free weekly newsletter at stockscores.com/newsletters.asp. If you've watched the market long enough, you will know that owning stocks that get bought out before they get bought out often leads to big single-day price gains. Now, obviously, if you know about a deal before it is announced, you can earn big profits, but insider trading is illegal, and of course, knowing about a deal and trading on that would be considered insider trading. Now, there's often people who do trade on inside information, and they create abnormal activity. A big part of what I do when I analyze the market is look for abnormal activity because it tells me a lot about what is going on with a company. Now, it's not illegal to follow the trail of abnormal activity, and sometimes you can get lucky by owning a stock that is trading on new information that is not yet widely known. Now, here's an example of what I mean. AUTH, a company called Authentech, was bought out on Friday at a big premium, went from $5 to $8.50 in one day. And what I want you to notice is that there was abnormal activity where I have circled in red arrows there, or in red circles. Not only was there abnormal price action, but abnormal volume. Now, I actually bought the stock on both of those red circles, and both times I got stopped out. So I don't want anyone to think that I did this perfectly. I certainly picked the right stock, but unfortunately my risk management was too tight, largely because of the state of the market right now, and I got stopped out before the big jump. The point is, however, the market did tell us that something was going on in this company, and only a few days later, Apple announces that they are buying the stock at a big premium to its market price. All right, let's get into the analysis. First chart of the week is the S&P 500 ETF chart, SPY. I have here a 60-minute chart going back 1 month because I want to show the gyrations that have been underway for the last 20 days or so, and how we are now at the top of this channel where the market will likely stall and head lower. It's important to realize that even though the market is speculating on quantitative easing from the European Union and the US Federal Reserve, we have also seen a pretty good rally here, so expectations are high. And I am doubtful that the market will get information or new news from the Fed and from the ECB that is better than those expectations, at least in the short term. I am optimistic about the market in the longer term because we have a generally rising trend over the last month, but we are at the top of that upward sloping channel, and that means we could see a pullback in the short term. Chart of the TSX is a little bit more difficult to track because it's been so volatile lately. We do have some compression of volatility, and we have seen a little bit of a break of a downward trend line. I wouldn't call it a crystal clear chart pattern, but this market is starting to look better, largely because the market is speculating on quantitative easing, which means likely a devaluation of currencies, which helps commodity prices. And of course, the Canadian market is heavily leveraged to commodity prices. The VIX, of course, the VXX is an ETF based on the VIX. It is often referred to as the fear index, and you can see that fear is really not a factor in this market. However, we have stabilized the downward trend. We are more likely to go sideways here, and if something goes wrong in Europe, or if the market doesn't like what it hears from the central banks of the world, we could see a little bit of a rally here. So I think you should keep an eye on this chart because it is a canary in the coal mine. If you see this thing start to move with volume, it's often because the world is concerned about something going wrong. 20-year bond ETF TLT is in an upward trend. It will break this upward trend if the market starts to feel like it can put risk on again. Right now, the buyers are largely sitting on the sideline. They don't want to jump into the market because there's too much uncertainty about Europe, about whether there will be quantitative easing, about earnings, about the employment numbers. A lot of those questions, however, may get answered this week. So if you see a break of that upward trend line, It means that money is coming out of the safety of bonds and likely coming back to the stock market. So watch this chart closely. US dollar probably goes up if there's quantitative easing, although if all the big central banks do quantitative easing, then all the currencies go down, and probably the US dollar holds its own against currencies like the euro anyway. But anyway, what we see here is an upward trend line shown in green. If that trend line is broken, that's good for commodities. Pardon me. Yes, that's good for commodities. That implies that the printing of money is going to devalue the US dollar, which makes commodities cheaper for the world. Expect gold to rally on that. Expect oil to rally on that. However, it hasn't happened yet. And what we are likely to see is the US dollar bounce off this level. I think you're going to see the US dollar head back toward that red line of resistance. And that's probably a little bit of a negative for the stock market in the short term. Gold has broken that short-term downward trend line. Still in a long-term pessimistic pattern because we have those falling tops, but we're one day away from reversing that short-term pessimism. And so I think gold is an important chart to watch. I've been bearish on gold for some time. It hasn't really gone down the way I expected, but certainly hasn't gone up either. And I think if gold can get through 158 on this ETF, then you probably want to cover any shorts in gold and maybe get a little bit optimistic about the gold miners. Again, hasn't done that yet, but it could happen this week, so keep an eye on it. Oil has been staging a little bit of a comeback rally, and many people think that oil looks good. I personally don't think so. It's still below that red downward trend line. This little rally has been a positive for the short-term trader in oil and gas stocks, but ultimately we still are in a pessimistic chart pattern, and until the economy improves globally, you shouldn't expect oil to do too much. If that green line is broken, that's a good sign that oil is headed back down again, and I would be worried that people who've been buying the oil and gas stocks have entered into a little bit of a bull trap. I am long a couple oil stocks, but I'm watching them very closely because I'm not sure that this trend will hold. So my outlook then is neutral on everything. But in the short term, I think weakness is likely after the recent rally. The market has really high expectations for what the US and European central banks will say and do this week. My longer term outlook is generally optimistic for stocks, but I expect there's going to be a good deal of turmoil along the way. And so I advise some caution. I suggest a relatively short-term approach to the market with good risk management, and don't be hitting for home runs. Try to trade for base hits right now. Well, that has been the Stockscores Market Minutes. I hope you all have a great week in the market and trade well.